Hi. Okay, Gabriel Josiah here again. All right, we'll be looking at our discuss on profitability ratios. We'll be looking at return on capital employed, which is the first ratio in our profitability ratio series. Okay, so let me quickly share my screen so that we can dive deeply into it practically. Okay, so profitability ratios. This ratio is expressed as the profit you generate from a business compared to the capital you invested. This is very important. It's expressed as the profit you generated compared to what you have as returns in the business. Okay, so the common definition of this metric or this formula or this type of ratio is profit before interest and tax divided by all the capital you provided internally and externally, which includes your share capital, preferred share capital if there is, your reserves, your retained earnings, and your long-term liabilities. You could also express this formula by saying your profit before interest and tax divided by your net assets. And your net assets include your total assets less your current liabilities. Now, this ratio can be broken down into the profit before interest and tax times your revenue or your sales, divided by your sales times your net assets, which is the same as your total assets less your current liabilities. So let's look at this company briefly and how the formula applies graphically or practically. Now, Sharubutu Nigeria Limited is a dynamic company in the Nigerian environment dedicated to delivering exceptional products and services to its diverse clientele. So we've been provided with a 3-year financial statement summary for Sharubutu Nigeria Limited. So let's look at how they've performed in the area of return on capital employed. So we have the profit before tax here, but we've not been giving the profit before interest and tax, but we have the interest provided to the loan both. Okay, so we'll add back our interest to the profit before interest and tax. So I'll just use Excel to calculate this. You could use your calculator as you're watching this video or later when you want to practice. I will go to Excel. I'll paste my profit before interest and tax here as the figure. Then I'll go and pick the loan that was deducted on the financial statements, and I'll add it back to the profit before interest tax so that I can have the actual figure of my profit before interest and tax. So what is the total? Our profit before interest and tax is 130 million naira. So we have our numerator figured out already. So let's go and pick the denominator, which is in our statement of financial position. So you have the equity and preferred stock. So we'll pick everything in the total equity and preferred stock, and we add it as a figure. Don't forget the total preference and equity. It's the figure we are using for the denominator. Also, don't forget to add your long-term liabilities, which includes the bank loan, bonds payable, and every other liability that is more than a year commitment. So let's go and add them to form our capital structure. So there is no bank loan, there is no deferred tax liability for the financial year, and we don't have bonds payable. So we have 200,000 naira for that particular financial year as our total non-current or long-term liabilities. So let's total the capital provided or injected, which is 800 plus 200. So we have 1 million naira, or 1 billion as the capital, since we have this provided here. So we have 1 billion as the capital provided. Now let's get our preference or our return on capital employed. In calculating it, we'll say our profit before interest and tax divided by our capital employed, which is 1 billion naira. And we have the total of 13% as our return on capital employed. Okay, so let's use the other variant, which has to do with profit for interest and tax, like we see here, divided by our net assets. Now, our net asset includes total assets minus our current liabilities. Let's look at that graphically. So still we have the profit before interest and tax. So we just get our total assets and our total liabilities to get the figure we need to calculate our return on capital employed based on that second variant. So let's go. So for Sharubutu and Sons, we have a total asset figure of 1.2 billion. So pick the figure and add it together. We go and pick our current liabilities, total figure, and come and add it together too. So our total current liabilities is about 400 million naira. And we add it to we deduct it, I beg your pardon, from our total assets. So our total assets less our total current liabilities gives us 800 million naira. So to have our return on capital employed using this variant, we practically take our profit before interest and tax divided by our net assets. So this is our net assets. This is our net assets. So let's calculate it now by saying our profit before interest tax divided by our net assets gives us a total of 15%. So it's a little bit varying, but the difference is not always much depending on both calculations. So looking at our formula here, you will see that ROCE indicates the return that the company is generating from the capital it has employed in its business. So in this case, you will see that based on this first variant, we generated a 13% return on our investment, which is okay for the first year. And for the second variant, we generated a 15% return on our investment, which is okay for the first year or the year provided in the financial information we just picked. So the meaning is that investors understand how effectively their funds or capital is used to generate profit for the business. Very important. So the capital employed includes total assets less current liabilities, or total equity plus debt. Debt including preferred stock and long-term loans, which could include debentures and other forms of external funding for the business. So what are the implications of the rules? Now, the implication of the return on capital employed from an investor's perspective or management perspective is that a higher return on capital employed value or percentage indicates that a company is more efficient in generating profit from its capital. It suggests efficient management and operational efficiency. So a company is well run. That is what it means. When you provide a high ROCE, you're showing that you run the company well. and management is efficient in operating the business properly. Conversely, or on the other side, a low ROCE may imply that the company is not efficiently using its capital, which could lead to lower investors' confidence and potential challenges in raising funds. So investors are discouraged to inject more funds or attract new ones or keep the existing ones when you have a low return. It's normal in business. Every business wants to generate profit, and if you're not generating profit, you repel investors. This is very important. And what is the cause and effect of this? The cause is high profitability from operations due to effective cost control and pricing strategy. So positively, the cause of a high return on capital employed is effective cost control, and the pricing strategies are maximized. Also, efficient management of capital and assets, growth in sales or revenue relative to capital employed are the effect or the causes of a good return on capital employed. Let's look at the effects of having a high return on capital employed. You attract investors. It suggests a strong potential for returns, while the effects of a negative or low return on capital employed may prompt management to investigate areas of operational improvement or reconsider capital allocation strategies. This is very important. So the cause and effects are positive and they are negative, especially as a result of your return on capital employed on a business. So in conclusion, the return on capital employed is a variable metric for assessing a company's financial health and operational efficiency. To provide insights into how well a company is generating returns from its capital injected or invested, and helps inform decisions regarding investments, financing, and the overall strategy to run the business. So it's very important management regularly monitors ROCE to help keep the business afloat, maintain competitive edge, and ensure effective capital utilization. This is very important. So from what we've discussed and the example we've seen, we understand that ROCE is a very important metric in profitability ratios, and a business will only attract investors based on how it will be able to maximize returns from capital employed. Thank you very much, and let me know what you think in the comment section based on this return on capital employed. If you have any questions, observations, kindly provide them. I will attend to them. And don't forget to like, share, and subscribe to the videos, the channel, so that you'll be updated and notified when new videos or studies tutorials are provided on the channel. Thank you very much, and bye for now.